Australia. It's a land of endless opportunity and possibility. But how can you best tap into it? In this investment series, we'll be following real live investors just like you, who are looking for unique investment opportunities.
We can take some risks now.
I want some sort of capital stability.
I want to know that my money's in good hands.
Together with their own financial advisor, they'll be given behind-the-scenes access to some of the best money managers from around the globe. Supported by the CEO of the Financial Services Council, these fund managers will face the guardians, the industry heavyweights whose job it will be to make sure our investors have all the answers they need to make informed investment decisions.
Can we bring it back to basics and just clarify what the fund is providing them exposure to?
Traditionally, though, clients have preferred to actually manage their cash holdings outside, and yet you're sort of making that judgment call for them.
Of that income, how much would come from dividends versus the option strategies and other sources?
Welcome to our new investment series. In this episode, you'll meet Maria Cook, a successful businesswoman who's looking for new opportunities to grow her portfolio. Together with her financial advisor, Rik Arendsen, she'll be looking at 3 very different funds who'll provide her portfolios with opportunities to grow.
You've just sold your property and you came to me and said that you're retired now, and with this extra amount of money, you were looking for an opportunity to get some growth in your portfolio. Correct?
Absolutely, yes. Yeah. My husband and I have done well out of property, and so we like that concept. Property in Australia at the moment is doing really, really well, but we do want the flexibility of more income. So you can't kind of get the income, particularly out of the property we had. So we're really looking for good capital growth because we've had that through property, and we're looking to have a reasonable addition to a monthly income as well.
Let me use an analogy which I think will probably resonate with you. If you imagine a fruit tree, right, the tree itself is probably the growth that you're going to get, but the fruit is the income that you're going to get from the portfolio.
Yeah.
And if we can build a strategy which says there's enough income or fruit coming off that all you've got to do is eat the fruit, you never have to cut branches off the tree, but the tree can keep growing.
You know that appeals because we're growing that tree for our children. So if we can keep eating the fruit, that would be fantastic. That's exactly what I want to do. But I don't only want to eat it, I want to enjoy it. So I want to go overseas, I want to have a good life. So you know that, Rik, my overseas holidays, they're your responsibility.
I understand. So we need to grow enough fruit that you can travel as well.
Absolutely, mate.
Very good.
Sally Lone is the CEO of the Financial Services Council. This organisation is the voice of financial services in Australia and represents funds management as an industry, as well as other financial services sectors.
Having diversity in a portfolio is very valuable because losses in one asset class can potentially be offset by gains in another. It helps to reduce the overall risk of a portfolio, which is critical in ensuring that your money can be preserved.
We've set up your portfolio so far that it's got some defensive assets and some growth assets, but with the extra money in, we're now looking for an opportunity to build growth in the portfolio. And what we'd put aside was some 3 funds that we wanted to investigate. There's a fund from AMP, a fund from IWF, and a fund from Capital Group. Let's go through some of these funds in a little more detail.
Okay.
First one I wanted to talk to you about was the Capital Group, which is the Dividend Growers Fund.
Okay, great.
Let's have a quick look at this video that we prepared for you.
When it came to actually pulling the trigger on the first investment that I made, that is a very, very scary moment because there's people who rely on us with their money to help grow it for them so that when they retire, they're going to be able to live comfortably. A number of years ago, the fund management business was actually called the trust business. And I think that word trust kind of really summarises what a tremendous responsibility that a fund manager has. It's not just a question of trying to make money quickly, it's also thinking about what we can do to help balance the world on a long-term basis. It's all about taking somebody else's money and looking after it for them and knowing that they trust you to do the very best you can with it. That's a tremendous responsibility, and it's something that I actually find enormously fulfilling in life. So the World Dividend Grower strategy is really designed to meet the needs of somebody who has recently retired, and they're faced with two challenges, and these challenges compete with one another. When you've retired, you're not drawing a salary, which means that you're relying on your savings, on your super, to actually deliver the income that you need to live off. The other need is that when somebody retires, folks reasonably aspire to live for another kind of 20 to 30 years, which means that you also need to protect the real spending value of your super. So basically you need to make sure that it keeps up with inflation so that the income that it generates is going to be enough to live off. And that means that you need to invest in higher return investments like equities and real estate. But these investments are riskier, which means that the stability of your income is a threat. The World Dividend Grower strategy is designed to help folks who have retired to actually deal with these very difficult challenges. It invests in a very special group of stocks, companies that firstly pay a dividend and secondly grow that dividend over time. And the reason that these dividend growth stocks are so important is because over time dividend growth has shown itself to be a very good signal for a type of company that we call quality growth company. So firstly, you need to have an underlying business that's actually growing so that you can grow proper cash profits, not paper profits, so that you can use them to actually pay a dividend. You need to have a solid balance sheet in order to grow the dividend each year. And you've also got to have management that has very good capital allocation skills. So they're very good at investing back in the company's growth or paying a dividend and actually growing that dividend over time. The evidence in support of dividend growth companies is actually very, very compelling. Over this period, they've generated a return of 10.5% per annum. So it's the only category of companies that have actually performed better than the broad universe. And they actually did this with a much smoother delivery of returns as well. This philosophy of investing in companies that pay a dividend and then grow the dividends roots all the way back, literally, to the very first fund launched at the Capital Group in 1934. It's called the Investment Company of America, and that fund is still running today. We're really excited about the opportunity to bring a strategy to Australia that is really built upon 80 years of heritage of dividend-focused investing. And our hope is that actually this investment strategy is going to be a big part of helping retirees in Australia meet their long-term investment needs in retirement, which is superior returns, decent level of income, and also stability over time.
Okay, so looking at that fund, what does that mean to you? And is that what you think you might be looking for?
Well, I do like that the basis of dividends because it shows that a business is cash flow positive. They're obviously sustainable. So yeah, that's appealing. I like the concept. It makes sense to me.
When you look at what you were asking for before, which is the whole, I want the fruit and I want the tree to grow, these guys will absolutely deliver on that. One thing you should be aware of is the fact that it's an international fund. International investments, they don't have the franking credits that we have in Australia.
Right.
Now, franking credits, are always hard for people to understand. You get a dividend of $20, and then later on, the Australian government, if it's an Australian share, gives you a tax refund of a small amount, say $4 or $5. And that's extra. It goes $20 plus $5 makes $25. From an international front, whilst you'll get growth from this fund and you'll get dividends, you won't necessarily get the franking credits, but it still will provide the fruit that you need, and it'll make up a portion of your portfolio.
And so what's the balance? Like if you would get a certain amount in a dividend and a certain amount in growth, how much of the overall gain would be dividend and how much would be growth?
So looking at the Capital Group, you'll find that you'll get a little lower dividends from an international fund manager and a little more growth. So I would say if you said, look, the average return was 10% for argument's sake, you might expect to see 6 or 7% from growth and 3 or 4% from dividends.
Okay.
Whereas from an Australian standpoint, you probably find it's a little more in dividend and a little less in growth.
Okay.
Now let's have a look at the IOOF Multi-Mix Fund. They've got a suite of funds, but what I wanted to look at specifically was the Australian Share Fund. So let's have a look.
I guess I was always interested in who owned all these big companies. You'd go shopping with your parents and there'd be this big department store, and who actually owned it? You'd walk down the street and you'd see a bank, and well, who owns that? Who runs that? And I remember Dad saying, well, if you can buy these things called shares, so that it was sort of described as, well, you can own a couple of bricks in that bank. And I just found that amazing. And I still find it really incredible today that, you know, most super funds, people are owning all these businesses, are all sharing in the whole growth of the economy. When I first started, I went out on a roadshow. A somewhat elderly couple were going to go around Australia. They wanted to buy a caravan. They'd picked out their four-wheel drive that they wanted, and they were about 2 or 3 years away from retirement. I was probably 23, 24 when I did that, and I thought, wow, this is actually quite an important role. It certainly gave me a sense of the gravity of the job. It's easy, especially when you're younger, to sort of treat it as I guess you're trying to beat a benchmark, you're trying to outperform. But in reality, when you boil all that down, it brought it all home that this is people spending in retirement. This is their outcomes they've been dreaming about, the goals they've had for a long time, really depend on how we perform. Multi-mix funds are really a multi-manager fund. No single manager has great skills in all markets, in all market conditions, for all investment strategies. I've been looking at managers for nearly 20 years, and every manager has strengths and weaknesses. So investing across a suite of managers really gives you access to the best manager in the best market. So we spend a lot of time just meeting with managers, going to their offices, understanding how they operate, really understanding what motivates the managers themselves, and then really selecting the best of those managers. So we have a range of multi-mix funds. The building blocks are asset sector funds in the major asset classes, so Aussie equities, international equities, property, fixed interest, cash, and each of those funds are a multi-manager portfolio, so there's a suite of specialist managers in each of those asset classes. We then take each of those sector funds and build what we call diversified funds, so balanced funds, where we're investing across a range of asset classes. So each of those diversified funds has a different risk-return profile to it. So we have conservative funds, which are much more allocated to cash and fixed interest and less volatile asset classes, through to our high growth funds, which are much more exposed to equities. We're very strategic in how we set the asset allocation of our diversified funds. So we'll respond to market conditions on behalf of investors. So when we see expensive markets, we'll be exiting those markets. Attractive markets, we'll be investing more heavily into those markets. So we provide very, very strong strategic asset allocation services on our portfolios. There's a lot of risk embedded in portfolios, and risk can often get overlooked, particularly when you're just looking at single managers. There's a lot of risk embedded in what asset classes you're exposed to. There's a lot of risk in what parts of the market you're invested in what parts of time. So we conduct a lot of analysis looking at our overall portfolio, really to make sure that we balance out those risks. So by investing with a multi-mix fund, you're not being exposed to one big risk in the market. We're investing across a broad range of opportunities and really managing that risk for you. We have a suite of multi-mix products, so our products have got a range of risk-return profiles. So it's really about matching one of our suite of products to your particular financial plan to really get you to that end objective. Our goal is for your retirement to look how you want it to be. So whether that's your overseas trip, a caravan you want to buy, glamorous trip through Europe, whatever it may be, our objective is to really help you achieve that retirement goal.
So what did you think of the fund, and what thoughts did you have?
It's interesting that they're actually a fund investing in other funds.
I know.
So that I've got to think about that and get my head around it. And it seems to me that that strategy is really based on the expertise of other fund managers. So I'm trying to work out how they keep tabs on that many funds and how stable the managers are in those funds. You know, because you're kind of investing in somebody else's expertise.
Do you know, you have absolutely nailed it in terms of understanding what you have to think about when you're thinking about IOOF. When we select a fund manager, we don't necessarily look at the stocks they're buying. We look at the investment team and how they go and select investments, because it's all about the expertise of the manager. Now, one of the things that's interesting about the IWF fund, as you said, is the fact that it's not investing directly in stocks, it's investing in other Australian share funds. Now, when they've gone and done that, they've selected funds specifically. They might have a smaller cap fund that they're investing in. They might have a growth fund, which isn't focused on dividends, but is focusing on growing. They might be investing in a dividend style fund. And so what they're trying to do is to build a blend of different funds, which is going to really give you diversity in that portfolio.
Okay, well, that's interesting. Yeah, I like that.
All right, now let's look at the AMP Capital Fund. This is a global infrastructure securities fund. How's that for a mouthful?
Wow.
This particular fund invests in a range of infrastructure investments around the world. Okay, let's have a look at the video.
Yeah.
I'd like to think that I invest money the way that Sherlock Holmes would. You base investment decisions on the facts. You ignore the noise, you ignore the chatter from the markets, and build the decisions that you invest in based on the facts that you can find. I started off doing a civil engineering degree. That was really what I wanted to do when I was growing up. I wanted to build dams and bridges in Africa to try and improve the quality of life for people. And then I fell in love with the financial markets. So now I have the great opportunity to combine those two passions to not only help build infrastructure assets, but also help build people's wealth as well. The fund is the AMP Capital Global Infrastructure Securities Fund. It's a fund that invests in the best infrastructure companies that we can find located in all parts of the world. So things like water utilities, pipelines, electricity transmission grids, as well as some transportation assets such as airports and toll roads. So we invest in what we call core and pure infrastructure companies. These are core infrastructure that deliver very stable returns through any economic cycle, and they're pure companies because they're invested solely into infrastructure rather than something else such as being a toll road with a construction company added on the end. What that means for the investor is they get a very safe growth return. So, for example, during the dot-com bubble burst and the financial crisis, general global equities really collapsed. But for global listed infrastructure companies, the profitability kept growing. These companies can have long-term regulation that guarantees the profitability and also long-term contracts with very little volume risk and overall sensitivity to the global economies. So when you invest in these companies, you can get good growth with good dividend yield and you can sleep at night. I think infrastructure is the best investment opportunity of my lifetime. When you look at the amount of money that needs to be spent on infrastructure worldwide over the next 20 years, McKinsey, for example, they estimate that $57 trillion needs to be spent on infrastructure by 2030. That's a huge amount of money. First of all, the developed world, places like the United States and Europe, have underinvested in their infrastructure for many decades, and they're needing to replace all of the obsolete infrastructure, the bridges, the roads, the electricity transmission pylons. And in the developing world, places like China and Brazil, they're building clean water systems and electricity networks and high-speed rail for the very first time. The opportunity in infrastructure is to find hidden gems, but the real way which we find the hidden gems is actually going to visit the company, going to meet the management that operate the infrastructure assets day in and day out. So one of the best times that I had was to visit Cushing, which is a town in Oklahoma in the United States, and that's where crude oil for North America is priced. And if you go to Cushing, what you find are huge tank farms that hold up to 500,000 barrels of oil each, and the place is covered in these tanks to store oil because it is the oil hub for the United States. It's called Pipeline Crossroads of the World. You can go and go and climb up these tanks and go onto the roof and to actually see all of the assets in operation, but also speak to the people who operate these assets to find out how excited they are about the jobs that they do and to find out more about the growth opportunity and how the tank farms are expanding with all the pipelines that are being connected into Cushing. I heard the story of one infrastructure fund manager who said to an investor, there's no point me going to visit the assets because I don't know what the assets do or how they operate. So to be a specialist in the space and to have a degree in civil engineering and to be excited about the assets that I go and visit, really think gives us an edge at AMP Capital. Because if you don't go and visit the asset, you can't make that decision. You listen to what the company or to what the market tells you, and you really miss out a very important piece of the jigsaw.
Okay. So, what do you think of that fund?
I like the fact that it's global, because if it was just Australian, I'd be a little bit concerned.
We don't have that much infrastructure.
I know, that's why I'd be concerned. And politically, they keep promising the world and never actually building.
Correct. So. I think the other thing you need to bear in mind with this particular fund, and one of the reasons I do like this fund, is you can buy it as hedged or unhedged. If we buy that AMP Capital Infrastructure Global Fund, and the Aussie dollar is 90 cents,
yes,
and then the Aussie dollar fell down to 70 cents,
right, yeah,
your investment in that fund would go up purely because of now that's unhedged, which means the currency has an effect on the valuation of the portfolio.
Right, yeah.
But what we can do with this fund is they offer the same fund, mirrored, but where the currency is removed from the whole calculation. And it's called hedged.
Hedged.
So what happens then is that the investments you buy, whether that's some tollway in France or an electricity company in Germany, you're relying on the underlying investment in those countries to perform, and the currency doesn't have any impact whatsoever.
Well, given the currency at the moment and what's going on in Europe, that I would definitely not want it unhedged. If I was going to go there, I'd have to have it hedged.
Agreed.
Yeah.
So any other thoughts you had or questions you had in relation to the Global Infrastructure Fund?
What's their balance globally in terms of infrastructure? Is it all developed countries, or are they looking at third world countries as well? Or because I think that's important.
I think it's one of the things we're going to have to investigate further and find out where is that money invested. Because, for example, if it's all in America, then you've got an American risk.
Yes.
But if it's spread sort of globally, then you're going to get some diversity in countries.
Yeah.
So, having been through the three funds, have you got any questions that are sort of lingering in your mind that you'd like to have answered?
Well, you know, the GFC was a pretty hard hit. I'm sorry, mate, but I would really, if there is a track record, I understand that one of them started in 2014, so it doesn't have the track record. But if there is a track record, I'd like to see their data compared to other funds, GFC, you know, just in terms of risk mitigation. And, you know, we're retired, so we can't have that happen again. The balance in infrastructure worldwide. So where is the infrastructure? What's the percentage in the US, Europe? Are they investing in China, Asia, India? I'd like to see that.
Sure. And the IWF fund?
I want to know what's their strategy if they're investing in managers and there's a sudden departure of a key manager in another fund. So how do they find that out and what do they do about it? And if they withdraw that fund, what does it mean if I've already invested in them?
So what we're going to do next time when we catch up is we're going to be looking in detail as the three fund managers pitch to the Guardians, and that'll give us a really good look at hopefully being able to answer some of the questions that you had.
Great, look forward to it.
Me too.
Head to theinvestmentseries.com.au to better understand how you can change your investment future. Gain greater insights into the fund managers featured in the show. And hear more from our Guardians on the featured funds. This is the start of your journey to making better investment decisions. Find out how you can invest today. You can also connect with us on LinkedIn and Facebook by searching No More Practice. Next time on the Investment Series, Maria and Rik get a front row seat at our Guardian grilling.
I believe that infrastructure is the biggest investment thematic of my lifetime.
At the heart of the multi-mix philosophy is really a belief that no single investment manager can be the best performer all of the time.
It achieves superior returns with greater stability of returns. And in addition, it also has an attractive income stream.
And their guardians will make sure that our fund managers are giving all the answers that Maria will need to make the right decisions for her portfolio.
Infrastructure as an asset class isn't well understood. Can we take a step back to the basics and describe what actually is infrastructure?
In terms of growth expectations or total return, what an investor could expect from this fund?
In Australia, it's hard to talk about income stocks or yield stocks without looking at the benefits of franking credits, particularly to a retiree. Can your fund stack up